Stocks, and by that definition mutual funds, have two sources of returns. Firstly, there is expected appreciation in the stock prices, and then of course there are dividends. So 50, 60 years back, dividends were a big deal, and stocks would often offer dividend yields averaging a good 6% per annum. But over time, this policy has become a lot more diverse, with companies offering high dividends, low dividends, and even no dividends. Now, for an optimist, a dividend stock offers the best of both worlds. That is, one gets upfront cash, and then there is a potential upside in the form of stock price appreciation. In the same way, for a pessimist investor, dividend-yielding stocks act as defensive instruments that provide some comfort, especially during stock market declines. With India and the world facing one such decline now, in this video we shall study some related data and see if a shift towards higher dividend-yielding stocks, ETFs and mutual funds can be an investor's answer to better tackling this somewhat uncertain equity market. Let's begin. There's a high degree of debate surrounding the question: does paying a high dividend make a company a more attractive investment? So firstly, there is the economic argument that says that the most efficient and strong companies can increase their total shareholder returns by offering a low or no dividend and by reinvesting the excess cash in growth assets like plants, people, R&D, products, technology, etc., which further compounds capital. Secondly, we have the gratification factor, and studies have shown that a little amount of money in your pocket, however unnecessary, is likely to give you more joy, which is the part that dividends play in spite of being tax inefficient. Thirdly, there is the perception argument wherein the markets extrapolate a dividend as a price appreciation signal and a sign of better cash flows and business optimism. And finally, there is the premise, and I truly support this one, which says that some managers cannot be trusted with cash, which is another way of saying that competent managers who allocate capital well are an exception in the business world. So as one can see, there are multiple angles to how dividends make their presence felt, and a lot of it becomes even more visible and important during bear markets, which shall be the subject of our study in the next section of this video. The last prolonged bear market we all saw globally was in the 2008 to 2010 period, when the effects of the global financial crisis were at its peak. So to better understand performance, we relied on a study which looked at companies with different dividend yields across many quarters. This study was done by researchers for the US markets, the S&P 500 to be precise, which anyways bore the brunt of the crisis. Now, the data here shows that the higher dividend-yielding stocks come out a lot better in most quarters. In fact, when we total the numbers, one finds that stocks that offer dividend yields of over 17% actually came out unscathed from the crisis, losing only 1% of their value, while stocks which offered no dividends fell by over 35% within those 10 quarters. So the question is, why would this happen? That is, why would high dividend-yielding stocks get so much support from market participants during a crash? Well, an obvious answer to that is yield support. So imagine you have two stocks. The first company does not offer any dividends, but the second company pays a dividend at a 5% yield. Now, say the stock market collapses and both these stocks are down by 50%, which means your second stock, that is the one that gives you a dividend, is now offering you a 10% dividend yield, which, truth be told, is far higher than what you would make on a fixed deposit. Even when we look at this from an exit strategy perspective, if you had to sell shares in one of these two companies, I'm pretty sure the stock on the way out would be the one that does not offer a dividend. So yield is a natural layer of support that a high dividend stock gets when there is a crash or a bear market. This effect can probably explain why the share price of a number of non-dividend paying tech stocks are down nowadays, and why an increasing number of retail investors are putting their money in dividend ETFs. So much so, even economists at Goldman Sachs are recommending a bigger allocation to high dividend yielding stocks under the supposition that there is a 1/3 probability of the US going into a recession. Point blank, high dividend yielding stocks are one of the best places to hide in a bearish market, with many fund managers scoring for companies all around the world that can offer a 5, a 6, even a 10% yield. In fact, at the time of recording this video, there are 52 companies in India with a market capitalization of over 1,000 crores that are offering a dividend yield of over 5%. As one might have expected, there are no IT companies in this list, and a bulk of these 52 companies are involved in areas like metals and mining, oil and gas, power generation, specialized finance, and commodity chemicals. Now, like everything else, a high dividend yield approach has some limitations, and as an investor, it's always good to know these. So firstly, there is the general perception that there aren't many high dividend yielding stocks that pay dividends consistently. There is definitely some truth to this. And as far as India is concerned, I think there are about 15, maybe 20 stocks that offer high and consistent yields. A second concern is that some stocks only appear to have a high yield, and the truth might be a bit distorted or uncertain. For example, Goodyear India Limited presently offers a dividend yield of 9.7%. In numbers, the company has declared a dividend of 100 rupees in this financial year, and the current share price is 1030 rupees. So 100 divided by 1030 comes to an yield of 9.7%. But the Goodyear management was never this generous with dividends for many years. In fact, dividends per share were in the 12 to 13 rupee range for many years, up until FY 2021, when the company unexpectedly increased it by over 700%. It was a move that surprised many, as the company would now have to arrange for and pay over 200 crores to its shareholders, which just a few years back was just 30 crores. In fact, mathematically, for the financial years 2021, 22, and 23, the dividend that was paid was almost double of the company's net profits. This simple illustration and observation shows us the level of uncertainty that surrounds dividends, and it's something investors need to carefully analyze and consider. Okay, so going back to the concerns, and yet another point that comes across is that many stocks appear to have a high dividend yield only because their stock prices have fallen sharply. For example, SAIL, or the Steel Authority of India, has seen its stock price drop by over 50% in the last 1 year. Now, they offered a per share dividend of 8.75 rupees last year, which came to a dividend yield of 6.5% per the stock prices prevailing in July of 2021. So if SAIL were to offer the same 8.75 rupees this year, the dividend yield per the current stock price would be about 13%. The point is, dividend yields are uncertain, they are sometimes unsustainable, and one also needs to factor in the life cycle of the business, as it's generally the mature or declining businesses that end up offering a high dividend yield. Mutual funds have a category called the dividend yield funds, and the primary goal of this category is to identify and invest in companies that offer higher than benchmark dividend yields. So speaking of a benchmark, the Nifty 50, or for that matter, the Nifty 500, operates at a dividend yield range of 1 to 1.5% at most times, which is not much, but it's still a starting point. Now, per the contours prescribed by the Securities and Exchange Board of India, these funds have to invest at least 65% of their assets in dividend-yielding stocks. But surprisingly, the regulator has not prescribed any minimum level of yield that is needed for a stock to qualify. This effectively gives fund managers a lot of flexibility, which they definitely utilize to invest in companies that either don't pay a dividend or pay low dividend. For example, the HDFC Dividend Yield Fund is the largest fund in this category with an AUM of 2,800 crores. The top 10 holdings of the scheme reveals that very few of the stock picks are high dividend yielding stocks. I mean, yes, there is a Tech Mahindra, an NTPC, and an ITC, but that's it. And in my opinion, this is a problem when evaluating dividend yield funds for investment, because while the schemes are tagged as dividend yielding funds, their holdings are more aligned to a large cap or a large and mid cap fund. But having said this, it doesn't mean that dividend yielding funds are doing a bad job with your money. This data for the last few years shows that across comparable categories, the dividend yield funds have been ranked fourth over a 5-year period, second over a 3-year period, and have been the top performer over the last 1 year. Of course, the path has not been a smooth one, and we have observed that these schemes stutter a bit during bull markets when investors are chasing growth stocks without worrying about cash flows or dividends. So, given this and the fact that there are methodology gaps in stock picking, it is suggested that you don't look beyond a small proportion of your capital when investing in dividend yielding mutual funds. A fair chunk of investors are gravitating towards high dividend yielding stocks as it adds more stability to their portfolio and also acts as a volatility hedge. Now, one effective strategy investors can employ when selecting high dividend yielding stocks is to mesh it with other factors, especially the defensive ones. For example, if given a choice, I would be happier investing in a high dividend yielding healthcare or FMCG company that has a growing demand curve rather than investing in a cyclical metal specific business. Similarly, one should prefer a low debt company in addition to a high dividend yielding one, because when the cycle turns for the worse, almost every management will opt for paying off the debts rather than paying a dividend to its shareholders. So, to improve your dividend stock selection, do spend some time and come up with a list of defensive criteria that you can use when identifying your preferred companies. A second strategy you can use revolves around dividend growers versus the dividend payers. Many studies have shown that companies that are consistently growing their dividends are likely to be a better bet when compared to investing in companies which currently offer a high dividend payout. In fact, the S&P has two separate indices around dividends: the S&P 500 High Dividend Index and the S&P High Yield Dividend Aristocrats Index. The first one, that is the S&P 500 High Dividend Index, is like a plain and simple Nifty 50 index, while the Dividend Aristocrats Index is a more refined index which tracks the performance of S&P 500 companies that have increased dividends every year for the last 20 years or more. As one can see here, this managed dividend index does a lot better than the simple index on many qualitative parameters, including the return on equity, earnings per share growth, and the long-term debt to capital ratio. A third and final strategy revolves around incorporating dividend-oriented equities into an investment portfolio as a substitute to fixed income allocation. Understandably, this is not for everyone, but for investors with a long-term orientation, moving debt to high dividend-yielding equities is likely to increase portfolio yield. It's also going to reduce interest rate sensitivities, although it will also lead to an increase in portfolio volatility. So these are some advanced strategies that one can employ or at least consider when working with dividend yielding stocks or mutual funds. And with this, we come to the end of this video. I sincerely hope this video has helped you understand the importance of a high dividend yielding strategy from a defensive perspective, a perception perspective, and how it can be a formidable inclusion in your investment portfolio, especially during a bear market. If you like this presentation, then do tap on to that like button and share this video with your friends and colleagues. Also, don't forget to subscribe to our channel, and I look forward to catching up with you next week on another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.